Hi, I am Ankur and I have over 20 years of experience in finance and investing. One of the reasons of making this video is I came across few videos by influencers and they were talking about specific investment into crypto and Microsoft stocks and so on. I just felt it was not the right way of advising people. Well, first of all, online there should not be any advice. It should be only guidance or education. So this video is primarily to give you few steps if you're a first time investor, irrespective of level of wealth you have. What are the steps that you need to take in order for you to manage your money better? So let's get started. The first area that you need to focus on is where do you stand financially, which is basically your net worth. That is total assets minus total liabilities. And in case your total liabilities are more than your total assets, you need to first address in reducing your total liabilities. And in case your total assets minus liabilities are positive, your objective or rather a report card on a yearly basis should be how this difference is increasing. That is, your net worth is increasing. People who do this assessment are bound to increase their financial strength year on year. So the first and the foremost area to focus on is net worth. The next step after net worth is understanding your cash flow situation, which is basically a difference between cash inflow and cash outflow. Inflow would include any form of income that you get in the form of, say, your salary, your interest income, rental income, and so on. Whereas cash outflow would include avenues where you are paying out the money. For example, you're paying for your rents or you're paying for child's education. Other living expenses that you're paying will all get included as part of outflow. So you need to create a monthly, quarterly, and annual income statement, that is inflow and outflow, in order to understand where do you stand in terms of surplus. So the difference between inflow and outflow is the surplus, and that needs to be deployed in order to increase your net worth. However, when the outflow is more than the inflow, then you need to understand how you can reduce your expenses first so that you are not eating away from your capital, because whatever is the difference between inflow and outflow is something that can generate surplus, which increases net worth, but in case it creates deficit, then that gets eaten away from net worth only. So you need to be careful not increasing your expenses beyond your income levels. So now once you have figured out your net worth and your cash flow situation, you need to understand how to deploy your funds and why you're investing your funds. So often people think in the form of buckets. So buckets are basically different financial objectives or goals that you have. For example, your child's education fund, your travel, let's say you have to buy a car in 3 years, and so on. These are all objectives that can be categorized as short term, medium term, and long term. But a prioritization is important. For example, your own retirement or child education will have a higher priority over, say, a travel plan or buying a car. So what is the way of prioritizing this? A simple hack to this is breaking down your financial objectives into needs, wants, and aspirations. Needs would be the baseline requirements, say retirement, child education. Want is something like if you want to buy a 25 lakh rupee car than a 15 lakh rupee car. Both are cars and will meet the same objective, but you have a want to have a 25 lakh rupee car. The third is aspiration, which is leaving your work and maybe starting your own work. So that will be an aspirational requirement. So you need to break down your objectives into 3 buckets, and needs, as the name suggests, will be the first priority, followed by want and then aspiration. Well, one of the common things across everyone is financial freedom, although other goals can vary, but financial freedom of retirement is something that applies to everyone. Interestingly, you get loans for education, loans for house, but there is no loan for becoming financially free. And a trend has been observed. With my client, I see a lot of people are retiring at 40, 45 instead of say 60, 65. So first of all, understanding, how much do you need for your financial freedom? It's a simple formula, although you can make it very complicated, but a simple way of getting that is whatever is your living expense, you multiply that by 90 years, which I'm assuming as expected life, minus the retirement age. So let's say your living expenses are 2 lakh rupees per month, which is 24 lakh rupees yearly, multiplied by 90 minus, say, your retirement age you want as 55. So what you need is around 8.4 crores. So if you have 8.4 crores when you're 55, then you can retire comfortably. You can debate that you have not considered inflation and interest rate and all, but it's a very simple formula. Sure, you can do the tweaking and get the exact number, but this number in itself is a ballpark number, and it will be a good starting point. Now comes how much do you need to save to achieve that. So let's say your current age is 30 years. So this 8.4 crores divided by the number of years you have until retirement. So it's 55 minus 30. So it's 8.4 crores divided by 25, and that will be 33.6 lakhs annually or 2.8 lakh monthly. And in case you have other ways of investing, say your PF contribution is going on, or there are existing mutual funds or other forms of investment, then the 8.4 needs to be reduced by the amount that you already have. A few years back, health crisis in the form of COVID happened, and it killed a lot of people. A lot of families were disturbed. So this topic is relevant to address that particular need, which is taking an insurance cover which comes in play if something were to happen to you. What should be the number? Well, it should be whatever is your working life, let's say 20 years or 30 years, and whatever your income is today, just multiply that to get that cover. For example, let's say your income is 20 lakh rupees yearly, and you are 20 years of age and you plan to work until 50. So there is a 30-year span of working life, which is simply 20 lakh multiplied by 30. It will be around 6 crores. That should be your insurance cover. And do not combine investment and insurance. Your cost of that product rises a lot. A better way is to buy a pure term plan from variety of websites. You can evaluate which one works better for you. This way you will have insurance cover. If something were to happen to you, that money will be given to your family. So whatever is your financial objective, if not fully, at least partially, they will be addressed. And in case insurance company is not willing you to grant insurance of the value that you want, then you should max out to whatever insurance company is offering you. At times they have their own underwriting criteria, and they may restrict the amount of insurance cover they can provide. So in that case, just max out whatever insurance cover you're getting from the insurance company. The idea of this video is to give you a practical sense in terms of how you should be thinking about saving and investing. It is not to make you a financial advisor, but to give you practical tools to get started. I have attached all the necessary Excel files for you to do your own working and create your own financial plan and start working towards that. Thank you for giving your time and watching this video.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL and certification from NISM in no way guarantee the performance of the intermediary or provide any assurance of returns to investors. The securities quoted are for illustration only and are not recommendatory.